The assumption everyone priced in. It wasn't written down anywhere. No rule required it. No model enforced it. Yet almost everyone believed it and built decisions around it without ever saying the words out loud. That assumption was simple. The system would respond. To understand why this matters now, we have to return to a period when markets felt dependable. Not calm, not euphoric, just reliable. When something moved too far, capital stepped in. When volatility rose, balance returned. Participants trusted that reactions would arrive on time, every time. This belief shaped everything. Risk models assumed responsiveness. Strategies assumed liquidity. Timing decisions assumed that if something went wrong, the market would correct itself quickly. The assumption wasn't optimism. It was infrastructure. It was treated as permanent. The first reveal begins with how deeply this belief was embedded. Traders didn't debate whether support would appear. They debated when. Investors didn't ask if liquidity would respond. They asked how much. The assumption wasn't questioned because it had worked for so long it felt structural. The second reveal emerged through behavior that seemed rational. Positions grew larger. Time horizons shortened. Leverage felt manageable. Why worry about exits when exits had always been there? The market rewarded efficiency built on that assumption, reinforcing it again and again. The third reveal came when small tests started behaving differently. Not dramatically, just subtly. Moves took longer to resolve. Support arrived later than expected. Recoveries felt mechanical instead of confident. Nothing broke, but something no longer felt automatic. Most people dismiss this as noise. They shouldn't have, because when an assumption becomes invisible, it becomes dangerous. No one monitors it. No one hedges it. No one prepares for its absence. It becomes a foundation everything else rests on, quietly unquestioned. The market was still functioning, but it was functioning on faith rather than proof. And once an entire system prices an assumption without realizing it, the real risk isn't that the assumption is wrong. It's that no one is prepared for the moment it stops holding. What followed will reveal how quickly markets change when an invisible belief begins to weaken, and why the most important risks are often the ones nobody knows they're taking. As that assumption quietly weakened, the market didn't react with alarm. It adjusted with indifference. Prices still moved. Trades still cleared. Systems still functioned. On the surface, nothing appeared broken. That's what made the shift so difficult to detect. The conflict emerged in timing. Reactions that once arrived instantly now took longer. Support didn't disappear. It hesitated. Capital waited to see if it was truly needed before committing. Each delay felt reasonable on its own. Together, they signaled something deeper. The system was no longer certain it had to respond immediately. Liquidity reflected this change first. Depth remained visible, but it behaved differently. Bids appeared briefly, then pulled back. Offers refreshed cautiously. Capital was present, but it no longer felt obligated to absorb imbalance. The assumption of automatic response was quietly being renegotiated. The tension deepened as this behavior repeated. Small disturbances lingered longer than expected. Recoveries felt procedural, not instinctive. Participants adjusted without naming the cause. Strategies were tweaked. Position sizes were trimmed. Time horizons shortened. No one said the assumption was weakening, but everyone acted as if it might. Derivatives markets hinted at the same discomfort. Protection stayed bid even during calm periods. Skew refused to normalize. Traders weren't pricing fear. They were pricing uncertainty about response. The risk wasn't collapse. It was hesitation. The buildup continued as confidence in the assumption eroded through repetition. Each delayed reaction reinforced the next. Each unresolved move trained participants to wait a little longer before stepping in. The market learned a new behavior pattern, one where response was optional, not guaranteed. Veteran participants noticed the danger clearly. Markets don't destabilize when assumptions break suddenly. They destabilize when assumptions fade quietly without being replaced. The old belief no longer holds, but nothing new has taken its place yet. The market was still standing, but it was standing on something softer than before. The assumption everyone had priced and was no longer invisible. It was weakening, And the next phase would reveal what happens when a market built on automatic response is forced to operate without it, even briefly. Because when assumptions fail, they don't fail alone. They take confidence with them. The moment the assumption was tested, the response told the whole story. A modest imbalance appeared. Nothing historic, nothing alarming. In the past, it would have been absorbed without hesitation. This time it lingered. Prices moved and paused. Participants watched closely, waiting for the familiar reflex to appear. It didn't. Buyers hovered instead of stepping in. Sellers pressed cautiously. Sensing the gap, the system still functioned, but it no longer rushed to correct itself. Automatic response had become conditional. The conflict intensified as this pattern repeated across sessions. Each delay reinforced the next. What once felt like noise began to feel directional, not because pressure increased, but because resistance weakened. The assumption that someone else would respond quietly dissolved. Liquidity exposed a shift clearly. Depth existed, but it withdrew under stress. Capital waited for confirmation before committing. Support formed after movement, not before it. The market had lost its ability to lead uncertainty. It now reacted to it. Institutional systems responded mechanically. Algorithms reduced aggressiveness. Risk controls trimmed exposure. Committees revisited scenarios. Every adjustment made sense individually. Together, they removed even more initiative from the system. The assumption had done unseen work for years. Without it, everything slowed. The buildup accelerated as correlations tightened. Assets that once balanced each other moved together. Diversification weakened. Strategies designed to rely on quick response struggled. The market grew heavier with each unresolved move. Veteran participants recognized the warning immediately. This wasn't panic. It was structural hesitation. Markets don't need fear to destabilize. They need uncertainty about response. When no one feels obligated to step in, small imbalances travel farther than they should. As days passed, levels that once held easily failed softly, not from force, but from neglect. Support didn't break. It never fully formed. The assumption everyone had priced and was no longer operating in the background. It had stepped aside. And without it, the market was being forced to discover how much of its stability had depended on something no one had ever named. The final phase would show what happens when an invisible assumption finally collapses under pressure, and why the aftermath feels sudden, even though the cause unfolded quietly over time. The collapse of the assumption didn't arrive as chaos. It arrived as clarity. Once the market realized the response expected was no longer guaranteed, behavior shifted all at once, not violently, decisively. That was the climax. Support failed not because sellers overwhelmed it, but because buyers never truly arrived. Liquidity showed up late, after direction was already set. Capital that had relied on automatic correction now had to reassess risk in real time. The market moved further than expected, not from fear, but from absence. What shocked many participants was how logical it felt afterward. Of course the move extended. Of course recovery was slower. The assumption everyone had priced and had been doing invisible work for years. Once it disappeared, nothing replaced it immediately. The resolution unfolded through adaptation. Strategies adjusted. Position sizes shrank. Time horizons shortened. Participants stopped assuming response and started demanding proof. The market stabilized again, but on different terms. Less fluid, more cautious, more sensitive to early moves. The deeper lesson lingered beneath every trade that followed. The most dangerous risks aren't the ones people debate. They're the ones everyone assumes away. When a belief becomes invisible, it becomes unprotected. And when it fails, the system feels suddenly exposed. Markets don't just price information. They price assumptions. And when an assumption breaks, price is how the market tells you. Understanding this changes how stability should be read, not as reassurance, but as dependency. What is holding the system together right now? And what happens if it stops? Because the moment an assumption is no longer shared, it stops being support. It becomes vulnerability. Subscribe to join the journey.